Welcome to this session. Let's continue our discussion on financial crisis 2007-8, and further let us also discuss the financial crisis in emerging market economies and other countries. So, we have seen in the last session we discussed until here, that means in stage 2 the subprime crisis led to the banking crisis, and we have seen that we discussed there was full fledged financial crisis. So, you can see here that actually Bear Stearns, the fifth largest investment bank in the United States, which had invested heavily in subprime related securities, had a run on its repo funding and was forced to sell itself to JP Morgan for less than 1/10 of its worth just a year earlier. In July, you can also see that Freddie Mac, two privately owned but government sponsored enterprises that together insured over 5 trillion of mortgages, were propped up by the US Treasury and the Federal Reserve for suffering substantial losses from their holdings of subprime securities. So, both firms were put up into conservatorship in September 2008. So, another which attracted the biggest news headlines, that was in Monday, September 15, 2008, Lehman Brothers, the fourth largest investment bank by asset size with over 600 billion in assets, filed for bankruptcy, making it largest bankruptcy in the US history. So, the day before, Merrill Lynch, the third largest investment bank, which had also suffered large losses on its holdings of subprime mortgages, subprime securities, announced its sale to Bank of America for a price 60% below its value a year later. So, the insurance companies, AIG, they also suffered extreme liquidity crisis because when its credit rating was downgraded. So, that means it had at that time it had written over 400 billion of insurance contract that had to make payouts on possible losses from subprime mortgage securities. So, here actually the Federal Reserve stepped in with a 85 billion loan to keep AIG afloat. That means we can see that too big to fail is actually that principle that saying is actually taking place here. So, there has been several other funding, mutual funds and who made an investment in this subprime mortgage. Mostly the investors, institutional investors, you can see that most of them were pension funds and mutual funds. Actually all these are funds from the general public, and then you know that that all have been invested in the mortgage, and but by 2008 most of them began to suffer huge loss. So, these firms, you can see that these many firms all came within a whisk of doing so and had to be rescued. So, we can see that this is actually the working of government safety net. Due to the government safety net, all these firms were saved. So, you know why this has been saved? Because government cannot allow these big firms, financial firms, to fail, because you know that if they fail, the entire financial system will fail, when it will adversely affect entire economy. Even the recession is going to become depression indeed. So, that is the reason government stepped in and they bailed out, rescued these firms. Many firms were rescued, and however the FDIC closed. You can see that there was several bank failure, 465 failed banks from 2008 to 2012. So, that is the height of all these are the heights of the stage 2 of that is the crisis, banking crisis. So, in this crisis we can see that the factors that we discussed in the previous sessions all started a huge role in this crisis. So, one is the conflict of interest. So, let us see how different stakeholders' conflict of interest played a role. So, coming to banks, retail banks, banks wanted profits from selling the mortgages to investors and cater to the rising demands. So what they did that, because the retail bank, we have seen that they sold out these loans to investment banks. Investment banks in turn made into RMBS and CDOs and sold out to investors, right? Real estate investors, mostly institutional investors including mutual funds. They wanted to make huge profit and there have been huge demand for these products, their mortgages. So hence they started to loosen their standards and started out give out subprime mortgages as much as possible. That is with the banks. So that means what we have seen in previous sessions, that means banks are expertise in screening of the customers, and also that in order to prevent adverse selection. But what they did that during 2000, in the year 2000, because of the mortgage boom and because of the financial innovations, that means huge demand for mortgage loans. These loans actually there is huge demand from investment bankers. They started to loosen their standards and give out subprime loans. And how about credit rating agencies? So credit rating agencies, what they did, they are the big three rating agencies gave brilliant ratings to these securities, and many of them were downgraded to junk status in 2010. So credit rating agencies who rate the quality of debt securities in terms of the profit probability of default were another contributor in this asymmetric information in the financial markets. So the rating agencies, we can see that they advise clients on how to structure complex financial instruments like CDOs. That is in one side, because we have seen that conflict of interest here, because credit rating agencies, they have both the ratings. On the one side they have ratings and another side they have the consultant for them. So they actually help many firms to structure complex financial instruments, for example the CDOs, RMBS and CDOs. While at the same time the same people, the same rating agency, they have been rating they are actually rating the same products as well. So that means same time they were rating these identical products. So the rating agencies were the subject to conflicts of interest because the large fees they earn from advising clients on how to structure here the product development, CDOs and all. So how to structure products that they themselves were rating meant that they didn't have sufficient incentives to make sure their ratings were accurate. And many individual and institutional investors, they were relying on these ratings, and this rating we expect the individual investors and institutional investors, they will be expecting an unbiased ratings. But what happened that because of the conflict of interest, that it was a biased ratings. In fact, it was a biased ratings. Biased ratings were given by these rating agencies. So that means the result was widely inflated ratings, biased ratings that enabled the sale of complex financial products that were far riskier than investor recognized. Then coming to other agency problems, how about the mortgage brokers? Those who act between the mortgage, the borrowers, the mortgage subprime mortgage borrowers and the retail banks. So that originated the mortgage brokers who originated the mortgage loans often didn't make a strong effort to evaluate whether the borrower could pay off the mortgage, because since they plan to quickly sell, that means distribute the loans to investors in the form of mortgage backed securities. So they don't have the strong effort, they didn't put strong effort whether the borrower could pay off the loan, since they would quickly sell, distribute the loans to investors in the form of mortgage backed securities. So this originate to distribute business model was exposed to the principal agent problem. So here the mortgage broker acted as agents for investors, but didn't have the investors' best interest at heart. So once the mortgage brokers earn his or her fee, what we can see, because they are not worried about the quality of this mortgage, because anyway they are earning the fee by selling this mortgage. Why should, obviously we can ask, why should the broker care if the borrower makes good on the payment? So the more volume the broker originates, the more money the broker makes here, right? So borrower, about the borrower's part, there also we can see that they had little incentive to disclose information about their ability to pay, because for them they see that they are anyway getting, their credit score is less, very low, still they are eligible for loan, and they are seeing that the loan they are getting in mortgage, they also see that the prices have been increasing, mortgage prices, housing prices have been increasing in the market. So they also feel that making capital gain, expected capital gain out of, because of that they have less incentive to disclose information about their ability to pay. And about the agency problem, again the commercial and investment banks, which were earning large fees buying, underwriting mortgage backed securities and structured credit products like CDOs, also had weak incentives to make sure that the ultimate holders of the securities would be paid off. So these people, these stakeholders also have huge incentive to engage in that means compromise their ethical standards here, right? So they are also making large fees, and then accordingly they also, and the conflict of interest, and they also didn't put much effort while underwriting the mortgage backed securities and CDOs. Because they didn't clearly really check the quality of the mortgage, the actual default risk of the mortgage, they were not much worried about that. So all these agencies, that the commercial bank, investment banks, they all had weak incentives to assess the quality of securities. Then coming the information asymmetry, because of the financial innovations, the financial innovation which led to financial derivatives, and that the derivative, that is the CDO, it was a derivative from RMBS. So there was actually, it is also called as securitization. So we can see the securitization brought new information asymmetries to financial markets, because the complexity of the instruments, the complexity of the instruments and their lack of transparency made it difficult for investors to evaluate securitized assets. And you know that they will be looking at the rating, credit rating of these products, that they will see that most products, all these bonds, most these products are getting high rating. So market based financial institutions like investment banks, money market mutual funds and mortgage brokers, all of them added fuel to this information asymmetry. So again we say that the information asymmetry, credit rating agencies who rate the quality of debt securities in terms of the probability of default were another contributor to asymmetric information and aggravated adverse selection problem. So as I just mentioned here, that means the general public, the investors will be looking at the credit rating given by the rating agencies, because they think that theirs will be unbiased rating, truly reflecting the economic fundamentals. But what they did, that they also added to the information asymmetry without really checking in the quality of their asset, quality of the debt instrument they are rating. So it also led to the issue of moral hazard problem. Before the financial crisis, financial institutions expected that regulating authorities would not allow them to fail due to the systemic risk. So there was a presumption that some banks were so vital to the economy and they were considered too big to fail. And this too big to fail feeling, it was so strong in the year 2000, that means they are all too big to fail, and this actually promoted or encouraged the moral hazard problem. So they engaged in risky activities, even most the retail banks, they began to lend to the subprime borrowers, and investment bank also did, and the insurance company insured this. And on the back of all this economic activity, financial activity, there was a feeling that if something goes wrong, government will save them. That is, Federal Insurance Development Corporation will pay off, bail out the retail banks. That is the expectation from the banking sector, because they won't allow the banking sector to fail, and similarly investment banks, insurance companies, they all had these expectations. So, given the liquidity provided by the collateralized debt market, lenders were able to relax their standards, because all these loans were based on the collateral. Collateral here is the mortgage. So, lenders made risky lending decisions under the assumption that they would likely be able to avoid holding the debt through its entire maturity. So, banks underwrote loans with the expectation that another party would likely to bear the risk of default, and creating a moral hazard and eventually contributing to the mortgage crisis. So, on the side of the government, we can see that government's various safety regulations in the banking sector, including deposit insurance, actually it was aim was to reduce the chance of bank failure, but we know that banks behavior, they started to take more risk than they did before. The government guaranteed insurance protects them from the losses. That was their belief from this banking sector, and this actually reduced discipline in the banking sector. So, in the one of the session we said that banks, they are expert in ensuring screening and collecting private information, and accordingly reducing the issue of reducing the moral hazard, adverse selection and moral hazard. But in 2000 we saw, because of all these factors, it led to the moral hazard problem. So, looking at this table, you can compare, for example, the investment made, the assets by the banks in 2001 and 2006. So, look at the real estate investment. By 2001 it was 20%, but it shot up to 33% in 2006. So, finally, the government intervention happened in 2008-9 period. So, the bailout package was debated. So, you can see that the debate was mainly between the Wall Street, that the financial sector, and the Main Street, that the general public. House of Representatives voted down the 700 billion bailout package, and immediately after that the stock market further crashed after this decision, and because of that by October 3, 2008, finally the Wall Street won against the Main Street. That means the taxpayers' money were used for bailing out the Wall Street. The Main Street's money was used for bailing out the general public, to bailing out the Wall Street. So, it authorized the Treasury to spend 700 billion in purchasing subprime mortgage assets from troubled financial institutions, and Congress approved 7-8 this much economic stimulus plan on February 2009. So, due to government and central bank intervention, the Great Recession was far smaller in magnitude than the Great Depression. So, the height of 2007-8 crisis, the stock market gathered pace in the fall of 2008 with the weak beginning of 2008. Decline in US history. So, surging interest rate faced by borrowers led to sharp decline in consumer spending and investment. Unemployment rate shot up, going over 10% in the level in the late 2009 during the Great Recession. So, let us now discuss the financial crisis in emerging market economies. Here what we are going to do, that we will make a short discussion about the framework that we discussed in the previous sessions. Here mostly in the emerging market economies, the stage 1 of the financial crisis was started with the credit boom and burst in the emerging market economies. So, during in the mostly because of the financial innovations in the developed countries, western countries, it also led to its effects were also seen in the emerging market economies. So, mostly emerging market economies means economies in an early stage of market developments that are recently open up to the flow of goods, services and capital from the rest of the world. These countries, because of the seeds of financial crisis in this economy, are often sown when a country liberalizes its domestic financial systems by eliminating restrictions on financial institutions and markets, which is a process called financial liberalization. So, as a result, what happened that When suddenly they opened up there because of the financial liberalization, they actually, most of the financial institutions, banking institutions, they started lending into new sectors where they are actually not well trained or have well expertise. But that means weak supervision and lack of expertise. They had this is the banking institutions in these economies were facing, and which actually leads to a lending boom in these countries. So when they engaged in lending, that means giving loans to even to subprime customers, and obviously you know that it has to burst up after certain period of point of time. So in this country you can also see that these domestic banks, they borrow from the foreign banks, they pump lots of money in their domestic market. Then in addition, they also had the fixed exchange rate. This has been giving them a sense of lower risk. That means there is no exchange rate volatility, so that they know that when they are borrowing from abroad they can pay back without any exchange rate volatility. So this also gave them a sense of lower risk. So all this, what they did, that the banks in this emerging market economies, they started making lots of lending for large lending in the subprime market. And however, after certain period of time they started experiencing the heat, that means the default risk. So another thing is that this is one, that the stage 1. In the stage 2 is that these countries also experience severe fiscal imbalances in the form of increasing fiscal deficit in this country. Because of that, governments in need of funds sometimes force banks to buy government debt. So they governments force the banks to buy government debt. That means when government debt loses value, banks also lose and their net worth decreases. There were some additional factors as well. That means the additional factors here is mainly increase in interest rates, especially abroad, due to the factors abroad. That means the precipitating factor in some crises was a rise in interest rate caused by events abroad, such as a tightening of US monetary policy. For example, when the Fed is making a tightening of their monetary policy, then you know that the rate of interest increase in the US, and this one will be further leading to increase in the interest rate in the emerging market economies as well. So that means when the interest rate rise, high risk firms are more willing to pay the high interest rates. So you can see that it leading to adverse selection problem. Right, this problem is going to become more severe in these countries. Adverse selection problem is going to become more severe. So because of the interest rate, the banking institutions are who are financial institution who are borrowing from the market. Because of that, the repayment burden, the debt burden increases, and because of that the asset price also decline. And in addition, it also led to the also due to the uncertainty linked to the unstable political system in the emerging market economies, that also contributed, and these points are applicable to the low and middle income countries as well. So in stage 2 we can also see the currency crisis, that means deterioration of bank balance sheet due to the currency crisis. The currency crisis here is that many market participants, that means actually many people, they make huge profits if they bet on depreciation of the currency of an emerging market economies. When such a currency is fixed against another currency, generally a currency of an advanced economy, the currency of the emerging market economies are often subject to speculative attack. That means speculators engage in mass sale, engage in large scale sales of this currency. As a result, their value depreciate, and then it will lead to a currency crisis. What we have seen in previous session, that when there is currency depreciation, then there is the debt burden of the borrowing firms increases, and it further leads to decline in the net worth of these firms. So let us see further. All these leads to a stage 3 full-fledged financial crisis in these countries, so that debt burden in terms of domestic currency increases. All these further lead to increase in expected and actual inflation, which all further reduces the firm's cash flow. So as a result, you know that banks are more likely to fail, individuals are less able to pay off their debts. So, because of the value of assets fall and debt denominated in foreign currency increases. So, that means these firms banks value of liabilities increases. So, this is the summary of the sequence of events in emerging market economies financial crisis. So, you can see that the increase in uncertainty, asset price and increase in interest rate, all this and deterioration in financial institutions balance sheet, all this lead to the problem of undue selection and moral hazard. Then the fiscal imbalances, that the increasing fiscal deficit, it also lead to deterioration in the bank's balance sheet, and this also leads to the foreign exchange crisis. All this lead to the worsening of the asymmetric information problem, and as we have seen, we can see here that it will lead to further the decline in economic activity, and it will further leading to banking crisis, and finally the adverse selection problems becoming even further more and more worse. And you can also see that all this lead to shrinking of economic activity declines, and economy is falling into recessions. So, in this session and last session, what we have done is we have discussed the financial crisis of in 2007-8, and also discussed this one with related to the financial crisis or in some emerging market economies. We didn't discuss the financial crisis in emerging market economies in detail. You can see that there are crises in many countries. For example, you can look into South Korea, you can look into Argentina, and other countries, Turkey, etc. But that actually you can apply all these principles there, and I am sure that now you are in a better position to understand the economics behind the financial crisis in many countries, including low and middle income countries as well. Let me stop here. Thank you very much.